welcome to LawWiser On Air. I'm your host, Alokita Tangri, and today we are discussing one of the biggest tax reforms since GST was introduced 8 years ago, the government's announcement of GST 2.0. The move simplifies India's complex multi-slab structure into just two primary rates, 5% and 18%, with a 40% slab for luxury and sin goods. This reform is expected to impact everything from household budgets to state revenues and from compliance for MSMEs to the pricing strategies for larger corporations. To break this down for us, I'm joined by two experts in indirect taxation, Mr. Maulik Manakiwala and Mr. Karthik Mani, both partners with BDO India LLP. Thank you both of you for joining us today.
Thank you.
Let's start with the basics, Maulik. Could you tell us how does the new two-slab model and the addition of a 40% luxury and sin goods rate compare to the current four-tier system, and what are the biggest changes that businesses need to be aware of?
Yeah. So first of all, thanks Alokita for having us with you on this podcast. It's a pleasure joining you. And just to begin with respect to those reforms, it's a complete reset with respect to GST. So like what we always used to say, it's like GST 2.0. It's actually GST 2.0 because government has literally simplified a lot of issues with respect to the rate rationalization. And when it comes to this, it was a long run story. Is like before 1.5 year, government had given this particular mandate, rather not government, but council had given this particular mandate to a group of ministries, and where they were working on this aspects that how they can rationalize the rates and make it more simpler for the common man to understand when it comes to GST. Hence, what they did is they moved from this four-tier structure to a two-tier structure, and what they are classified now is pretty simple in structure. One is a merit rate, that is all your essential items, that is classified under 5%. Another is particularly a standard rate, that's all non-essential items which are classified under 18%. And third is demerit rate, so that's 40%. So where they're classifying all sort of sin goods and your luxury products. So when it comes to issues with respect to classification, or for a common man or probably MSME and all to understand where to classify, what to classify is something where it's just simplified. Furthermore, this is something it's adding to the purchasing power because ultimately consumers are going to benefit from those lower rate structures and all. And when it comes to overall ease of doing business, this is one step towards ease of doing business as well.
Thank you so much for explaining that so clearly. Now, moving on to you, Karthik, could you tell us what economic conditions or policy objectives drove the government to simplify the GST structure 8 years after GST's rollout? And how does this move align with broader goals of stimulating consumption and easing inflation?
One thing is whether this entire fraction has started now. There is a lot of rumors in the market that says that because of the US tariffs, we are getting into this. But the government had this plan from the day one. So when the GST was implemented, the government wanted to have a simplified system. So, but because of a lot of economic factors that are there, the complex nature of the Indian economy and the rate structure that we had, whether it's VAT, central excise service tax, we couldn't do it on the day one. So the government is slowly moving ahead. So it has taken 8 years right now. I think if you compare it to a lot of other countries, we are moving way faster than them in the process of simplifying it. And we are taking large strides towards it. So if you see today, the government wanted to have a simplified tax structure, which is two rates right now. We have brought it down to two rates today. And I will not be surprised the 4 years down the line, 5 years down the line, government comes up with GST 3.0 and says it's a single rate structure, right? And then on the tech side of it, day one, we didn't had a lot of data from the government side. Today, we have 8 years of data and everything is digitized. We are in a process where the return that needs to be filed is almost auto-filled for the taxpayers. So all these factors that the steps that the government took over the last 8 years has resulted in this, and it's not a factor or anything that is triggered recently. This is the wave plan of the government. This is what they had planned, and we are moving right in the right path right now.
Very interesting. Thank you so much for that. Now, Maulik, so which everyday products from toiletries and staples to electronics will benefit from the cut to 5% or 18%? And what does this mean for household budgets, especially considering the festive season ahead?
Honestly speaking, if you ask me, this is something probably for the first time when we are looking at is like council came for a 2-day meeting. They ended up in a 1 day, and the press conference was also at 10 in midnight. This is all just a push from PM's speech on 15th of August that okay, before the festivities, this should be done and this should be closed. So a lot of festive cheer for households, to be very honest. And if you ask me, there is a range of 10 to 15% cut on those products. So, right, 10 to 13% cut on those products, because if you talk about festivities, major consumption or major buying is going to happen around your FMCG, FMCD, your consumer durables, your automobiles, textiles, footwear, and across all the sectors, there is a complete rate cut. So if you ask me about the daily essentials, it's been already brought down from 12 and 18% to 5%. So there's a steep cut across the board. With respect to education, education has also been brought down from various rates of 12 and 18% to 0%. Automobiles, it's a significant boost to that industry, because when we talk about automobiles, it was earlier like in 28% to 50%. So that has also been reduced to 18% and 40% now. And particularly with respect to textiles and footwear as well, they were reduced. They're rather not reduced, but they increased the thresholds from 1,000 to 2,500 rupees and all. So ultimately, it's going to make things more affordable, as well as when it comes to festivities. I think these are the sectors wherein people are going to focus more with respect to the consumption as well.
Right, right. Great. So, on the other end of the spectrum, the introduction of a 40% rate hits luxury and sin goods hard. So, what is the government's justification and what are the expected consequences for those sectors? Could you please tell us more?
I'll address that. See, first of all, I'll take the two questions. One is how's the impact that is going to have on these organizations, and then whether it's justified or not for the government to have a rate of 40%. If you look at the 40% rate, the goods that are getting into it, it's a very, very minute amount of goods or services that are getting into that category. Now, the 40% slab is not something new today. Okay, if I have to put it across that way, we had a 28% slab, but along with the 28% slab, we had something called cess. So if you were buying a luxury car earlier, you were paying something in the range of 50 or 55%. Okay. Similarly, let's say if it was services also, wherever we had goods that was classified under 28%, those things always had a hint of compensation cess, which was triggering the overall net tax impact as much more than 40%. So if you actually see the impact for them, if I have to take a sector, let's say auto sector for that matter, they had something in the range of 45 to 55 that has come down to 40. So it is not necessarily it's an increase in the tax rate. Yes, there will be certain sectors who will be having a hit, for example, IPL tickets for that matter. So it was at 28%, there was no cess on it, but it has gone up to 40%. Yes, it's a hit. So they have to prepare for it, and it's maybe a sector that might not get hit because of the kind of craze that is there, but it is a hit to them. And there is no justification for it from my end, at least. And if you look at the companies, how they have to prepare for it, right? One good thing for the companies is there is no compensation cess, right? And since there is no compensation cess, they can have clarity that it's just 40% tax rate, lower than what they were paying earlier. So they have much more clarity in their business. One threat that the business have to face is what happens to the compensation cess that they have today. So they would have had paid compensation cess on their inputs. It will be sitting as a credit to them today. The government has not given any inputs on whether they will give credit of this for future, or there will be any grandfathering provisions around the compensation. There's no clarity on that. So that is something that will hit these sectors.
Thank you so much. Very interesting. And the fans will really have to shell their pockets now.
Yeah. Yeah.
So coming back to you, Maulik, with the trimming of slabs and reduced tax burden, how significant is the anticipated fiscal shortfall? And what mechanisms or compensation measures might need to be deployed to keep state revenues buoyant?
So I think this is a very interesting question, and probably during the press conference as well, we saw that almost all the media houses were asking this question again and again. But honestly speaking, I'm pretty much aligned with the revenue secretary's thoughts, because the statistics and all those things that they have in hand right now, based on which the rationalization exercise has been conducted, that is with respect to FY 23-24. And now when we are talking about today's economy as well as the consumption pattern, it's way different than what it used to be earlier. So when it comes to the loss, it might be a knee-jerk reaction as per me, because that will come to know once we have collection numbers, maybe next month and so on. But it's a knee-jerk reaction, but going forward, it's definitely going to boost overall consumption as well as increase the number. Because there is more purchasing power in the consumer's pocket. So right now, say for example, if some person has a budget of say 10,000 rupees a month, he would end up paying say for example, hypothetically 1,500 rupees as a tax. Now, probably if that person is going to pay 500 rupees as a tax, then he has more like 1,000 rupees more in his hand to spend it somewhere. And it's not just restricting us to indirect taxes, that will also help us in increasing the direct taxes contribution as well for the government. Because more the purchasing power, the person is going to go and buy out more products means more profits to the companies. Ultimately, it's just going to boost up. And with respect to the states, I think a lot of states are dependent on GST, but states have their own set of revenue as well. So particularly with respect to the states, I think it should not be a major impact, because when it's about a tax cut or anything, it's like center and state both are contributing to the tax cuts. So what all share they are going to get from the center itself. But if the consumption overall is getting increased, ultimately everyone is at benefit. And particularly with respect to the mechanism to compensate the states, I think states might come up with some sort of small changes with respect to their local state taxes and all. But there is nothing much that's happening from the GST perspective, because I think compensation size is also very much clear that's also going to end. So overall, everyone is going to benefit just out of higher consumption.
Glad to know that. Very interesting. So now, Karthik, from a compliance angle, will GST 2.0 actually make life easier for businesses, especially MSMEs, or will it bring new challenges? Also, what are the biggest risks for businesses during the transition? For example, how should they deal with pricing changes, stock that was bought under old rates, billing issues, or anti-profiteering rules?
So, let me take the first question, whether the compliance burden will come down for MSMEs. Uh, See, one, in the Prime Minister's budget speech, he mentioned that the returns is going to get automated. But as part of the GST Council, there is nothing of that sort. So there is no automation of the returns that they are envisaging as of now. So return continues the way it used to be, no changes in the return. Only additional measure that they are bringing in is registration related, which they are saying registration, two categories. One, somebody who's starting a business and their transaction is going to be very, very minimum. Let's say 2.5 lakh per month outward tax they have. To those taxpayers, they're saying we will have a simplified tax registration, which is like you apply for registration within 3 days, it gets auto approved. So that is something simplification. And one more for suppliers who are supplying through e-commerce platforms. If today there are restrictions on whether they can do supplies in other states, because then they have to obtain registration in other state, do compliance in each state where they are having operations. So the government is saying they will come up with a scheme that will simplify this process for people who are supplying through e-commerce. So we don't know what is the scheme, but we have to wait and see how that's going to be. But overall, if I have to conclude on simplification of return compliances, I don't see that coming as of now based on the GST 2.0. We should wait and see whether in future they will bring up more simplification for the return compliance process. On the uh, next question, like what are the risks that are there for the businesses, right? And how they have to deal with the current stock and current goods that they have hold of. Uh, for businesses, yes, it's a overall impact. It's not just a tax impact for the business. If I'm the business person, I need to look at it from a overall how it's going to impact my operations, my stock, my marketing. It could be any aspect of the business. There will be a slight impact because of the GST 2.0, and you need to first evaluate that. Let's say they have a stock today, for example, they have a stock today and they bought that stock at, let's say, a higher rate, 18%, and that stock needs to be sold, let's say, after 22nd September at 5%. What am I going to do with the credit that gets blocked? The government is not going to give a refund of it because that's not going to be treated as an inverted duty structure. What will I do with that credit? What is the strategies that I should use to ensure that I don't get into a situation of working capital issue? So businesses have to plan these things, and immediate requirement for few of the businesses will be the pricing strategy, whether they how much of the benefit of the rate reduction they have to pass on to the customers, whether it won't be exactly the same percentage. Let's say there is a goods that was at 28%, it has come down to 18%. It's not a simple math that I reduce 10% of the price. It won't work that way. So they have to go back and see what is the cost involved, how much input tax credit they are losing because of the rate change. Is there any other dependencies like working capital or everything? Based on that, they have to arrive at a price that helps them to retain their profits also, as well as passing on the benefit of the rate reduction to the consumers. So they have a lot of things to do by before 22nd September.
Very interesting. So actually, my next question sort of is around what you just mentioned, passing on the benefit to the customers. So coming to you, Maulik, is there something that you would add to that? As in, how can companies prepare themselves to show that they are passing on the benefits of lower tax to customers and complying with the anti-profiteering provisions? Also, how do you believe that this reform will play out differently across sectors like FMGC, automobiles, real estate, hospitality? You had earlier mentioned a few of these in the previous question. Also, which industries will benefit and which ones might face more pressure?
So particularly with respect to the question that you had, I think with respect to benefits, I think sectors at large are going to benefit. So FMCG is definitely a beneficiary because that's always going to help them with respect to rural as well as urban consumption as well as demand. Automobiles is again going to be a big beneficiary because probably today, if it would have been a distant dream for someone, a significant price drop, like the smallest of the smallest car, if it's getting cheaper by say 50,000 or a lakh rupees, it's always going to be more affordable for any person as well. Automobile is one more sector. Again, there is a lot of focus on farmers and agriculture. So when you talk about fertilizers, when you talk about tractors, a lot of rate revisions have been done and it is rationalized to 5%. Particularly with respect to those rates, one interesting aspect that they have done is they have reduced the rates to 5% rather than bringing down to zero. Had it been the choice, they would have definitely exempted those products as well. But ultimately, that would end up in additional burden on the consumer because in the entire supply chain, if ITCs are going to get blocked, it's ultimately going to increase your costs as well as the pass on is always going to be on the end consumer. So it would have been even a disaster. So one very good move that government has taken is with respect to bringing down the rates rather than completely exempting the products. Unless it is pretty much required, like education sector or a defense sector, something of that sort, and the pharma sector. So some critical 33 drugs, which are life-saving drugs, they are exempted completely. That's again a good move. Things are factored in the pricing and all those things. But when it comes to other sectors, I think it's definitely going to help these sectors when it comes to overall rate reduction.
Very interesting. Thank you so much for that. That brings us to the end of this discussion, and it's been very insightful. Thank you so much, Maulik and Karthik, for breaking down the implications of GST 2.0 so clearly. That's all for today's episode, and thank you to our listeners for tuning in. Until next time.